Happy spring, everybody. This is Darrell from the Wealthspire Investment Team back with our March installment of Markets in 2 Minutes. News flow is moving very quickly when it comes to the ongoing conflict in the Middle East between the United States, Israel, and Iran, and markets have thus far been pretty resilient. But with this month's update, we wanted to zero in on what we perceive to be the most significant risk surrounding the war, which is how oil markets are responding and how that might translate in terms of direct impacts on the U.S. economy. Now, it's rather intuitive that given the instability in the region and the effective closure of the Strait of Hormuz, a key choke point for oil supply, that would lead to higher prices. But generally speaking, the US economy is better positioned than it has been historically when it comes to insulating itself from surging oil prices. And the first line of defense, so to speak, is that US oil production is currently at all-time highs. And the chart on your screen is mapping out US oil production over time, and you can see where things had previously peaked back in the 70s and 80s when it was thought that we had sort of depleted our reserves. But then in around 2010, we had some technological breakthroughs, think fracking, that helped us to extract oil we didn't previously have access to, and that led to a massive resurgence in US production and led us to where we are today. So that helped the US economy to give itself some cushion against overseas disruptions to oil supply. That doesn't mean that US consumers are completely insulated, as I'm sure everyone has experienced when filling up their gas tank recently, but this dynamic is an important consideration, and we'll build on that idea with this next chart. The other key factor working in favor of US consumers is that food and energy costs make up a significantly smaller percentage of consumer budgets than they did just a few decades ago, especially compared to the oil crisis back in the 70s. So we're talking about a price shock that is no doubt going to have an impact, but that impact is likely to be muted relative to history. Obviously, the longer this conflict goes on and the more oil prices stay higher for longer, that does have an impact on the economy and on consumers in particular. But ultimately, given the productivity of the US oil industry and the makeup of consumer spending, those impacts are still likely to be relatively small and shouldn't unilaterally threaten to derail the earnings and growth story that's currently alive and well for the US economy. Thanks for checking in with us, and we'll see you in April for our next update.